Welcome all for the sessions on technological innovation management and entrepreneurship. Today we are going to do module 5 on how to start a business, financing and how to start a business, financial opportunities identification, banking sources, non banking institution and agencies, venture capital, meaning and role in entrepreneurship. Together with that, we will also do some multiple choice questionnaire on the same. Now, in today's class, we are going to know about what are the facilities that is available in financing a business that we want to start. So first, we need to identify what are the opportunities that are there to start a business. To start any business, money becomes one essential commodity without which we cannot think of starting a business. So let's see what are the opportunities that is there, what are the different kinds of financial services that we have when we think of starting a business. Now, according to the recent study, they tell that over 94 percentage of the new businesses fail during the first year of the operations. That is because lack of funding turns to be one of the most common reason. Money is the bloodline of any business. The long pain, staking yet exciting journey from the idea to revenue generating business needs fuel called as capital. That's why almost every stage of a business entrepreneurs find themselves asking, how do I finance my startup? Business simply cannot function without money, and money requires to make the business function and is known as business funds. They are classified based on the period for which we use the money. So, depending on the time period, the financial opportunities have been divided into time period, ownership, control, and the source of generation. So, depending on these things, the financial opportunities are divided. Whether you're going for a long term money fund, or you're going for a short term money fund, or you're going for an ownership, or you're giving little control on your business, on your idea, all those things, and from where you're generating the funds, depending on these things, they are being classified. So let's see the classification of financial opportunities. On the basis of the period, it is divided into long term equity, medium term, and short term. Long term equity is further divided into equity share, retained earnings, preferred shares, debentures, loan from financial institutions. Medium term, again in medium term, loan from banks, public deposits, loan from financial institutions. For short term loan, they trade credit, banks, commercial papers, they use all these things for a short term credit. On the basis of the ownership, it is again further divided into two, that is the owner's fund and funds and the borrowed funds. Owner's fund is the equity shared and the retained earnings. Borrowed funds are debentures, loan from banks, financial loans from financial institution, public deposits, lease financing. All those things come under borrowed funds. On the basis of the source of generation, it is again further divided into internal sources and external sources. Internal sources is again equity, share, capital, retained earnings, and external sources are the financial institution, loans from banks, preference share, public deposits, debentures, lease financing, commercial paper, trade, credit, factoring. All these things come under external resources. Now, you also have something called as non-banking sources. Non-banking sources is the equity financing. In this, the shareholders fund, and it may be in the form of equity capital, preference, internal actual venture capital, and angel investing. Equity financing means exchanging partial ownership in the firm for funding. Equity shareholders enjoy the reward as well as bear the risk of ownership. Equity capital, this represents ownership capital as equity shareholders collectively own the firm. Preference capital. Preference capital, this represents a hybrid form of financing. It has some characteristics of equity and some attributes of debentures. Internal accruals of a firm consists of depreciation charges and retained earnings. Next one is the venture capital. Venture capital, it is a finance invested by professional called venture capitalist in startup which has a potential growth. Next, venture capital. A venture capitalist provides guidance to the company and is a business partner sharing both risk and rewards. Venture capital is an important source of equity for startup companies. Venture capital injects equity finance with a solid capital base for future growth. Venture capital firms provide equity for business and expects 20 to 40 percentage equity stake in the company or high returns on their investment within 3 to 5 years. Now, what are the stages in venture capital financing? The requirement of funds vary with the life cycle stage of the enterprise. Depending upon the stage of the finance, venture capitalists are called as angel investors. As per this models, this activity is five-step process as follows. Deal organization, screening, evaluation or due diligence, deal structuring, positive investment activity and exit. Angel investing. Angel investors are wealthy individuals who invest in entrepreneurial firms usually during startup. They provide cash to young investors and take equity in return. Angels are usually entrepreneurs who have successfully built companies or have spent a part of their professional career in mentoring startups. Angels invest their own money and actively mentor the company. Angels usually expect a low return on investment when compared to that of venture capital firms. Next one is debt financing. Debt financing is basically money that is borrowed to run the business. Debt financing refers to the borrowing money from the source outside the company under certain terms and conditions relating to the interest rate and the period of return of the principal amount. Most entrepreneurs prefer to start their operation with money borrowed from banks and financial institutions. Term loan and debentures are the two important ways for raising long-term loan. Debts, term loan is the financial institutions and bank have traditionally been the primary source for long-term debt for private and public firms. Long-term loans represents a source of debt finance which is generally repayable in less than 10 years. Debentures for large firms. Debentures are a viable alternative to term loans. Debentures often provide more flexibility than term loans as they offer great choice with respect to maturity, interest rate, security, repayment, and special features. So debentures are more flexible when compared to these term loans. So this is about some identification of financial options for to start up a business. Let us start do some multiple choice questionnaires on what we did just now. First one is equity funding is preferable especially when the project is fund intensive, B intensive, C, capital intensive, and D, application intensive. So the answer is C, that is capital intensive. Question 2, private placement covers what all it covers? Private placement covers shares. A is shares, B is preference shares, C is debentures, and D is all of above. So the private placement covers, answer is D. It covers shares, preference shares, debentures, all the three it covers. So the answer is D, all of the above. Third one, financial services through the network of elements such as Dash serve the needs of individual, institutions, and corporate. Who give the financial services through the network of elements such as, who all can give financial services? Financial institutions, financial markets, financial instruments, all of the above. It is answer D, all of the above. All these three guys provide a kind of financial services only. The next one is Dash is regarded as the fourth element of financial system. Financial services, financial market, financial instrument, and financial institution. Dash is regarded as the fourth element of financial system. What is regarded? It is option A. Financial services is regarded as the fourth element of financial system. Dash is a financial intermediary who helps to mobilize and transfer capital from those who possess it to those who need it. Who is the one who gives to the need? Is it A, lease finance, B, venture capital, C, merchant banker, D, hire purchaser? It is option B. Venture capital makes he becomes the intermediator who gives, who has it, and who gives it for the one who is in need of it. So this completes session one on business, how to start up a business or the financial opportunities in starting up a business. Thank you very much. Thank you for your attention. I'll meet you in the next class.